Washington is in panic. The dollar is weakening. BRICS countries are dumping US debt, and even longtime allies are increasingly switching to settlements in Yuan. The message from the White House is clear. The dollar must be protected at all costs. But behind the loud speeches and tariff threats, fear is growing stronger. America is losing control over its main weapon, its money. For decades, the entire world relied on the dollar for borrowing, trade, and savings. Now that trust is melting before everyone's eyes. Over the past year, the dollar has already lost nearly 10% of its value, and demand for US bonds is rapidly falling. From Asia to the Middle East, countries are looking for new ways to finance themselves without Washington's approval. While Trump rushes to restore confidence, the world is entering a new reality where dollar dominance no longer looks inevitable. Trump's Asian tour is no longer about trade as much as it is about defending the reputation of the American currency. This became especially clear during Treasury Secretary Scott Bessent's visit to Japan. Instead of urging the Bank of Japan to raise rates, he insisted only on stabilizing the exchange rate. A strong yen could finish off the dollar, and Washington cannot allow that. Since the beginning of the year, the dollar has already fallen by almost 10%. Investors around the world are pulling out of US bonds, once the most reliable assets. The problem is simple. The fewer countries buy US debt, the more expensive borrowing becomes. That is why every new measure from Washington is aimed at protecting the dollar, even as markets sense that stability is slipping away. The world is entering a phase where the dollar's role as the backbone of the global financial system is no longer guaranteed. A quiet but powerful shift is taking place in global markets. Countries that once depended almost entirely on the dollar for borrowing are now seeking alternatives. In the first 5 months of 2025, the volume of dollar-denominated bonds issued by foreign governments fell by 19% to $86 billion, the first drop in 3 years. At first glance, the figure seems small, but it highlights the main point. Confidence in the dollar is weakening. High US interest rates and the falling exchange rate are making debt payments increasingly burdensome, especially for developing countries. Any fluctuation in the rate increases their debt load. The dollar, once a symbol of stability, is now more often seen as a tool of pressure. For Washington, this is a worrying sign. The lower the demand for dollar bonds, the fewer buyers for US debt. For others, this is a chance to diversify. Some are turning to regional currencies, others are developing domestic markets. But one thing is clear: the foundation of dollar dominance, built on trust and accessibility, is crumbling. This gradual capital outflow is reshaping the global financial landscape, while China is building its own liquidity network through the yuan. Indonesia's decision to issue its first offshore yuan-denominated bond became a turning point for all of Asia. The so-called dim sum bonds allow investors around the world to buy yuan securities outside mainland China and completely bypass the dollar. And this is not an isolated case. More and more countries and companies are issuing debt in yuan. The volume of such offshore bonds has grown by about 8% in a year and reached 720 billion yuan, or around $12 billion. The trend has strengthened since 2022, when the US began sharply raising interest rates. Back then, the world faced a shortage of dollar liquidity, but now it is no longer a coincidence. It is a deliberate shift by countries away from the dollar. For Indonesia, the reasons are obvious. It needs stable sources of financing, but without the risks caused by Washington's trade decisions. After Trump imposed a 19% tariff on Indonesian exports, the inflow of dollar revenue began to shrink. Last year, Indonesia sold goods worth $24 billion to the United States and bought only $10 billion, leaving a surplus of $14 billion now under threat. At the same time, Jakarta committed to purchasing $20 billion worth of American energy and agricultural products and $3.2 billion in aircraft, draining even more dollars from its reserves. When exports fall while dollar obligations rise, a liquidity trap emerges. Borrowing in regional currencies such as the yuan helps protect against it. For Indonesia, this is not a rejection of the United States, but a search for balance. For Asia, it marks the beginning of a new financial network where the center of gravity shifts toward China. Across the developing world, the financial map is changing. and the yuan is becoming its central currency. Within BRICS and among their trading partners, more governments and companies are borrowing, lending, and settling transactions directly in Chinese currency. The volume of offshore yuan bonds has been steadily rising each quarter since 2022, when US rate hikes triggered a global liquidity shortage. From 2022 to 2025, the yuan was under pressure as rising US interest rates increased demand for dollars, weakening China's currency. Trade with America remained relatively open. Now, the situation is reversed. The trade war has redirected global flows toward the yuan instead of the dollar. And if the Chinese currency strengthens by at least another 2%, analysts expect hundreds of billions of dollars could be dumped from balance sheets as importers and exporters move their reserves and settlements en masse from dollars to yuan. This shift is not about politics or ideology, but simple practicality. Borrowing in dollars is becoming increasingly risky, and the yuan is gradually turning into a more stable and predictable currency for those who depend on Chinese goods. And demand for those goods keeps rising. In September alone, China's total exports grew by 8.3%. Shipments of electric vehicles increased by 11%, semiconductors by 30%, and shipbuilding products by 40%. Every percentage point of growth strengthens the yuan's influence, as more buyers need Chinese currency to pay for their imports. Inside China, the trend is the same. In September, Chinese banks sold nearly $52 billion worth of foreign currencies in a single month. Exporters and importers massively converted their earnings back into yuan. This large-scale move away from the dollar shows that confidence in the Chinese currency is growing, and its role in global trade is becoming stronger. From Asia to Africa and even parts of Europe, the process is accelerating. Countries see that settlements in yuan reduce currency risks and eliminate extra costs for dollar conversions. Meanwhile, in Washington, Trump proudly claims that the surge in tariff revenues proves the success of his trade war. On paper, the numbers look impressive. Customs tariff revenues rose by 153%, reaching nearly $120 billion. But these figures do not solve the main problem. Even with this inflow of money, the federal deficit still stands at $1.8 trillion, the same as a year ago. The reason is simple. Government spending continues to rise in every direction. Social security, defense, healthcare, and debt payments are consuming an ever larger share of the U.S. budget. Interest payments alone have reached a record $1.2 trillion. That means 23 cents of every dollar Washington earns now goes solely to paying interest, the highest level in 25 years and twice as much as just 4 years ago. Economists call this fiscal dominance, a state in which spending dictates policy rather than the other way around. Once caught in this cycle, it is almost impossible to escape. The United States cannot meaningfully cut defense or social programs, especially amid its economic confrontation with China. That leaves only two options: borrow more or let inflation erode the debt. Both undermine trust in the dollar. While Washington clings to tariffs as a short-term lifeline, deeper structural pressures are building beneath the surface, pointing toward a far more serious financial crisis. Trump faces the Federal Reserve's dilemma: print or crash. Treasury Secretary Scott Bessent has almost no room left to maneuver. The American economy has reached a point where every decision carries enormous risks. Keep rates high, and debt servicing will strangle the economy. Lower them too quickly, and inflation will flare up again. It is between these two extremes that the White House and the Federal Reserve now find themselves trapped. The decline of the dollar is no longer just a market issue. It is a question of confidence. And that confidence is shifting eastward, toward nations that no longer wait for Washington's approval to pursue growth. The BRICS countries are building their own systems, their own credit lines, and their own future. How far will this reversal go? Will the world manage to move away from the dollar entirely, or will the United States strike back to reclaim its dominance? Share your thoughts in the comments, and don't forget to like and subscribe. See you in the next video.